All right, let's see. So people do hear me. Okay, nice f bomb. Okay, well, Kevin, I think it was on your end. Anyway, let's start that over again then. Says we're good now. Anyway, that has been deleted. We've got a new one going here. It's Friday, the 19th of August, 2011. And let's take a look at this market here. Thanks for tuning in to Stock Twits TV. This might be one of the final live shows, by the way, for Stock Twits TV. I'm sure you'll probably see some news about that over the weekend. But anyways, I do thank you for tuning in. We'll figure something else out. But let's take a look at this market because it was a hell of a wild market this week again. We have, of course, a declining 10, 20, and 50-day moving average. And, the market is generally guilty until proven innocent. But the short term, we had that rising 5-day moving average that it seemingly wanted to hold above. Obviously, that changed Thursday morning with the gap lower. And then we, kind of got crushed in there. We've been talking about risk, and the risk in this market was definitely that, well, the risk to those who were shorting early was that maybe this market was going to go past that resistance and head back up towards the 20-day moving average. Obviously, that didn't happen. What we want to do is we want to look at it and say we're not trying to predict necessarily what is going to happen and rigidly stick to a belief. Instead, we want to be aware of what are the potential scenarios. And we were talking about this level, and that if it got below this level, and actually in particular the bigger level where the market kind of broke out from at 118-ish, let's just call it, that if it got below there, then a retest of the lows was likely. Unfortunately, a lot of times, when we have a major level like that, it takes a big gap, and a lot of the opportunity is removed from the market that we might ordinarily be able to trade if it had been just a nice clean break and just some good panicky selling rather than a gap. We have to deal with what we have. We can't look at our dream scenarios. We look at our dream scenarios and say, if this dream scenario occurs, here's how I'm going to trade it. But when we have these key levels broken, you have to take them very seriously. In particular, when we have such badly damaged daily time frame, that is the larger time frame, and when we have all this still this macroeconomic news where we're not getting any clarity at all. It's just the world continues to change, and the market, the uncertainty is being reflected into price action. Today we had a pretty interesting session. Actually, we had initially that gap lower, and I put on Twitter I was happy to see the gap lower because I thought maybe there would be a bounce opportunity, and there was in fact. We were buying in right as it crossed the VWAP, and that was probably a little bit late, but then it pulled back perfectly to the volume weighted average price, and there was just a fantastic rally in here. Look at how let's look in particular at the E-minis, because when you have a gap day, it's more important to look at the volume weighted average price for the E-minis, because they had the E-minis that is get represented the volume that occurred overnight, and that therefore we are taking into account the trading that occurred between 3 a.m., 4 a.m., 8 a.m., and that sort of thing. So we get, I think the market tends to gravitate a little bit closer to that volume weighted average price. And you see that first pullback after the equities were open here, just a real nice bounce from there. And then this afternoon, once that volume weighted average price became resistance, we had a real nice tradable bear market as well. So we had a great bull market in the morning, a bear market in the afternoon, and people are saying, someone asked me, hey, am I going to talk about the crash that's going to occur on Monday? I don't know if there's going to be a crash on Monday. No one knows what's going to occur on Monday. The path of least resistance is lower. News and surprises tend to follow the trend. It wouldn't surprise me, but maybe we're going to get a big gap higher first, just to screw with all the people who held short over the weekend, and to get people excited, thinking like, hey, well, we didn't crash over the weekend, and here it is Monday, the buyers are coming in, so I've got to get involved and chase this market. I don't want to get stuck into any particular belief. I do think that it would be good to see at least a test, and better yet, an undercut of the lows from last week before we have the ability to kind of chop around a little bit and so chop around a little bit and start to rebuild. We've dropped the ball out of the 10th floor. It bounced up to the 4th floor. Maybe we go a little bit into the parking garage on the next bounce or drop, and then up to the 2nd floor. Either way we look at it, we know we've still got this big level here of that 38.2% retracement off of the 2009 lows that we've been looking at. The volume weighted average price from the 2009 lows is right in this level as well. So you take that into consideration, a move down towards and just below 110. I would welcome that on Monday. I think that would be a really good thing. And look at the volume starting to dry up a little bit. Typically on that, on a test that we're going to get a bounce from, that is we want to see at least a little bit of an undercut, or an undercut is ideal. If you remember that 2008 chart, let me actually pull that up. I'll pull up that 2008 chart, and we'll take a look at that for. I got too many charts in here. I don't know which one it is. I think it said daily 50 with no volume. Okay, and I know what I got to do to get that to show. Let me detach the window. SPY, add a bunch of days, and then we'll take a look at that again, because it was interesting. We pretty much tied the lows back in 2008, almost perfectly actually tied those lows, and here we are on that first bounce. We came a little bit short maybe. So we had that first move lower, a big bounce, and then the market came back down, and a lot of people thought double bottom. And maybe it will be a double bottom, or maybe we'll just get this big bounce and then the market begins to settle in, and then we get that little flush out here again. So we don't want to look at it and say this is going to be a double bottom. We don't want to look at it and say here's what's going to happen. We don't want to say the 38.2% retracement, that is support. The Fibonacci is, or the not Fibonacci, but the volume weighted average price, that's support. Yeah, those things come together nicely in an area, but those are reasons to look more closely at shorter term price action to see if it is confirmed by price on the short-term time frame. That is, that there's evidence of buyers. Now, one somewhat encouraging sign here is that we have less volume on this drive lower. The theory there is this was the real fear driven sell-off. This was panic. This was the big margin calls. Then we had some people chasing the market, and a lot of people, what they like to do is when they think they've got the low, take some profits off first of all if you're buying into that stuff and catch some bounce. But they think they caught the low, and then they like to set their stop just underneath the prior low. So a lot of times what happens is we see that low is just slightly undercut, and then a violent turnaround occurs. The Nasdaq did not actually make a new low. The low last week was, I believe, 93 cents. Why is it turning up so big? 93 cents. Today's low was 99 cents. So 49.93 was last week's lows. That looks obviously, easy to do, and maybe it will be in the Nasdaq where we get that first, that quick turnaround here. The semiconductors did break down through a new low. I tweeted about that because this is a group that I follow closely, but someone had mentioned on Twitter that actually the transportation index was the first one that the transports yesterday got through last week's lows. So there are markets that are leading to the downside, and we were talking about a leader to the upside, which was the IYR, and how it was starting to come into this prior resistance. This is a commercial real estate index, that is. I was coming up to that prior support and had the potential to become resistance. This was really just in a nice uptrend that obviously got smashed all at once, and then from there, though, there has been a pattern of lower highs and lower lows. We had slight little higher high there this morning, but the market, speaking of higher highs and higher lows, gold just continues to run away. A lot of people were calling it a top on this day right here at 171-ish or so. I mean, this is why you just can't tangle with these trends. If you do, only for short periods of time. And the same, excuse me, picking the top in gold is really no different than trying to pick the bottom in the S&P. You can get nice bounces in here, and in gold you might get nice little sell-offs where you can quickly make some scratch on the short side, but it's not the high probability low risk trade, and that's really what we need to be focused on. That's really the angle, or the perspective from which I try to do these videos and frame the analysis around. Is we're still in a bearish environment. Is it a bear market? Who cares what you call it? It's an environment where it's easier for the market to go down and stay down than it is to bounce and hold on to those gains. It's the path of least resistance is lower. So we've got still a messed up market if you're a bull. If you're bearish, then we've got a lot of volatility, and that's the good news. Again, on this 1 minute chart, we had a beautiful bull market in the morning and in a horrendous bear market in a decline. If you bought here and held it, well, you would have ended up losing. Had you sold short on that first pop and held it, maybe you would have made money. But there's a lot of good little trends that develop throughout the day, and in this type of environment, an environment where the average daily volatility, and the way what I was talking about on Twitter today was, I just took a look at the since the beginning of the year. I put them in a spreadsheet, and I forgot the number now, but I think it was, if you measure the high to low each day, and just say it was like 75 cents or 85 cents, whatever, and divide that into the price that the market opened at that day. So how big of a percentage range did the market trade in that day? Not compared to the prior close, because that's going to give you much different numbers, especially with these gaps. But how big of a range was there? How much opportunity was there between 9:30 a.m. Eastern and 4 p.m. Eastern time? And for the entire year, I believe it was 0.7476%, something like that. And since the beginning of this month right here, August 1st, and now we're down 12-13% this month. I don't know what the number is, but the average daily range from high to low has been 3.2%. So it's much more volatile. You don't need a volatility. You don't need a VIX to tell you that. The VIX is up high, and again, I'm not qualified to analyze the VIX. I look at volatility as how much price movement is there. So back to the volume. The volume, there's not as much fear this time down, and that a lot of times is what creates that. You've got a less intense sell-off, and where there's less intensity, that means there's less emotion. Maybe people are just tired of this nonsense here. I know a lot of people are really feeling worn down and tired out by this volatility, because they're trying to hold it for more than a day or two, and getting whipped around and watching big profits turn into break-even trades if you're lucky, or in disciplined, or turn into losses worse. So it's going to continue, I think, to be a volatile environment. Don't listen to anyone that tells you when we've made a double bottom or a cup and handle or whatever. Those are good guidelines. They're things to observe, but just drill your price action down to shorter term time frames to really see what's happening. To try to say a true double bottom is, it would come down, it would bounce back up, and this would be called point A. This is point B. Right up in here, the bounce high. This is point C. In order for it to become a double bottom, we only know it, according to a textbook, once it gets above this point B level. So, if we get down to 110 and then bounce up to 121 and a half, then officially we had a double bottom. officially is foolish to look for. Most of these things are with technical analysis. And I love to trash technical analysis because it's what I do for a living, and I need to remind myself and others that it's not a blind science to follow. It's a way of looking at the market that helps us identify what kind of conditions we're in, objectively try to determine risk reward, and then use some common sense, shorter term time frames, and then manage risk. Have some way of measuring, managing the risk that you take in any trade, because if you're not managing risk, you're going to be out of this market. And I'm sure there's a lot of people that are just getting thrown out of this market on a daily basis in here. If you stay true to risk management and proper position sizing and everything that goes along with that, then you're going to be okay regardless of what type of environment we have, whether it's 3/4 of a percentage point that we bounce around in each day, or if it's 3.5% range that we have in a day. Don't get hung up on the textbook stuff. It's no different. I love to make fun of fundamental analysis too. It's no different than buying a stock at a 10 PE because it's a value, and last year it was a 30 PE. Next year it might not have a PE at all. Anyways, I kind of went on a rant there. Thanks for tuning in, everybody. I don't know what's truthfully, I don't know what's going on with StockTwits TV, and I don't know if I said too much there, but I do appreciate everybody tuning in, and continue to go to alphatrends.net. I'll put videos up there and stuff. Thanks for tuning in, your support, and have a great weekend.